Warren, I wanted to give you an overview of how this product works that I was telling you about. So I'm going to enter a new customer here, or this is a new client of the user. And let's say this person is 40 years old, male, they're in Nebraska. And then we'll just put in some numbers here. This is their annual income. I'm just going to put it at 120 so we can distinguish it from other things. I think we're going to bump this up to 4 just for now because it might be more realistic. And then it has some, we can start with some, let's see, gross income of the year. Let's say it's 100. Okay, for this year, nice round number. Living expense 10K, and we're just going to leave in most of these default values here for retirement age and percentages, and then we'll add in a couple of these. They have tax qualified retirement plan assets of, let's just say, $30,000, just so we can distinguish these numbers, and they're contributing $1,000 a year, and then let's make this one 50,000, and they're not contributing. Let's see, and then we'll put this. They have a passive income one of annual amount, let's say 20,000 a year. Let's say 2,000 a year. Let's make it small, reasonable. Okay, and that's it. So we'll leave out these insurance things because this is typically what is going to be sold to them. We could add them in, but it's just to simplify the process here. And we hit save. I think did I make it John Doe? Yeah, John Doe. Okay, so this is their after-tax retirement income goal. So this is what we start with, and this right here is what we're going to show them. So this will be what the financial advisor, wealth management person presents to the user, to the client, not the user of this app, but their client. Okay, and then we continue. Here we can hit continue at the bottom or just move along these top values. So this is 120K per year in 2026 is going to need to be 300,000, over 300,000 in 2052 with a 4% inflation. That's what we're starting with as a goal. Now we have some passive income coming in. I didn't continue it. I could go back and continue it for 10 years. Let's edit that. Let's continue it for 10 years just to give an idea. Make it a little more typical, let's say. Okay, and then we go back to the retirement planner. So here's our passive income for those years, and that's going to work into this calculation here. So we can see a year by year to reach this amount, passive income isn't contributing a whole lot. It's knocking the 374 down to 372. A little less than that. Okay. And then we can work through I think I didn't add any tax qualified or other type of assets, so we can just look at the end result here, and we'll see that after tax retirement income, I guess I did add a little bit in there, and that brought it down for the first year. Really didn't add a lot of items in here. So let me go back to a different client where I've already populated some of these values. Let's look at Bob Smith. I think he has a better. He doesn't have passive income. So let's look at Bob and Cindy Brady. They've got some passive income, and they also have a little bit of tax qualified assets. And they've got, this is what they expect from Social Security. Save and continue. Actually, we didn't even update that, so we didn't have to there. But now you can see that the numbers are a little more filled out by other sources of income. When we go over here, we see that their initial $150,000 is what they are targeting as their goal, is not met. It's got a shortfall at the bottom of $700,000, but they can fix that by additional capital this year of $400,000. That's what it's going to take to bring their target of 700,000, or I should say, let's see, at the end, their targeted total will need to be, so they are retiring already very soon, so their targeted total is going to be $186,000 per year at the end of their retirement. So because of the short time frame, they are going to have to contribute $400,000 starting now. So this cycles through, this looks at the end of your retirement period. You're retiring for 20 years here, and at the end of that, this is your shortfall. In order to get $150,000 a year, equivalent in today's dollars, with this passive income and with Social Security paying not, and less Social Security. Okay, so this is 150, so the Social Security is already deducted from this first column, and you can see that more over here. There's the social benefit, Social Security annual benefit that pays down this $150,000 retirement by the end, and that's going to leave you at this point. So this is already paid down by Social Security by the time we see it in this column, and here's the pay down from passive income, annual passive income, $45,000, and we have a couple of payouts from these assets right here. So this allows you to kind of balance that all out and see the end result at the end. And this person is not leaving, does not have a targeted legacy goal. their legacy, if they want to leave an amount at the end of retirement, as we call it, they want to leave $0. They don't have anything planned there. To adjust that, they could just go back here, supposing they wanted to say, okay, I'm going to leave, I want to leave a legacy goal of $100,000 for somebody of their choosing. And then that's going to affect this number over here, where they're going to need $30,000 more now in order to leave 100,000. And this is additional capital required per year here. So they're going to be able to use this chart to figure out how to update their income, which we all want to do, and improve that revenue generating thing to hit their goals. This gives them an idea of when the deficits are going to come into play, how much the deficits are going to be. That's very important. And what they can do to turn that around and make it more acceptable to their idea of how they want to live in the future. So they can increase their income, reduce spending, and various strategies. Let me know what you think.